But if you're not invested in ARK Invest, what does it matter to me, the Tesla investor,
Not at all.
outside of all this?
Nothing.
Completely agree. When I started looking at them, they had 13 million stock. So when they did something, it moved the market, right? Now, with not even 4 million stock left, ARK is not moving the market anymore. It is not.
We're making
I just
lots
wanna
of
make that
friends
point.
today. We're making lots of friends.
Yeah.
We're in good mood, Herbert. Let's go.
Let's
All
go.
right, let's go. All right, everybody, welcome to CyberBulls. And so this is going to be quite a fiery episode. We're going to have a number of topics that's going to be very interesting. We're going to have Alexandra Mertz going to do a presentation on ARK Invest. We'll talk about all the different analysts out there and what they think about Tesla. We'll cover the Tesla Model Y, the new model that came out, the Cybertruck near term. It's going to be a delivery event. And then, of course, big things are happening. Like there's a GM recall and something else. Yet one more thing happening with Elon, with the SEC. So let's go through that. We've got Alexandra Mertz, Christian Valente, Jeff Lutz, and Xander Sky. Let's get started with that first one. Let's go straight to the GM recall. What do you guys think is happening there? And is that a big deal? Let's start with you, Jeff.
Yeah, I think this involves multiple companies actually, as they all source from like in a similar supply basis. So I think this has to play out. There's nothing official yet. This is kind of a leak of what may happen, and then we have to see. Basically it started at the root of like these components are causing a potential serious issue, and which vehicles, and they kind of have a list of of serial numbers and time, or VIN numbers versus time. And there was an estimate that there's more than 20 million GM vehicles that would be on that list. So that's kind of where this stands at this point. And, we'll have to wait to hear more. Obviously, it's a very serious issue if it involves not only the safety system not working, but the safety system potentially, having, dangerous consequences at, inopportune times. So we'll have to see how this plays out. It's just it's kind of another thing. If you kind of look at GM's bad week or month, I know we do spend time, but these are competitors to Tesla. And if you just play back just the last month of what's happening with the UAW strike progressing and deepening in terms of number of sites striking, and kind of they're also getting deeper in this negotiation where it's just quite frankly going to cost more for GM. And then you had their CTO, who's been at GM for a while and progressed inside of GM, but basically has been in the CTO role for a month and leaves. So I mean, executives leave companies. We've had our fair share of that at Tesla too, but it's just kind of another kind of inopportune thing with GM, and then now you have this. The only thing that I think that's really saving them from a stock price perspective is they're trading 4.8 times. So from a PE perspective, so that's really you can't really go much lower. But yeah, that's where this stands right now. There's nothing that's out there that's official, but it's just kind of I would say a well-sourced story of something that may happen.
Yeah. This is the news article from Wall Street Journal. GM has at least 20 million vehicles with these airbags. And, this is not something they can just do over the air to fix. These inflators have been known to explode with too much force during a vehicle crash, sending metal shrapnel flying and hitting occupants in the face and neck with shards. 2 people have been killed, several others injured. This is not just GM. Ford, Toyota, Volkswagen, Hyundai. So what do you guys think? Oh my gosh, this is going to be big, 20 million cars, and then not just GM. What do you think, Alexandra?
Well, it's going to be a recall. We had these in the good old days, quite often, that people had to bring their car back in. Obviously, as Tesla users and drivers, we're overspoiled. The quality is better, and whatever needs to be done can mostly be done over the air. But I mean, I do recall we had a Ford, we had a Mercedes, and they were regularly recalled and repair done at the dealerships. It's going to cost them billions at a moment where they don't have billions, neither Ford nor GM. I mean, Toyota has good deep pockets, but for the other ones, it's going to be, a painful experience. Now, as you all know, in automotive, everything is subcontracted. So this is a tier 1 or tier 2 subcontractor who is gonna have to pay for them. So this is gonna be kicked. The financial burden is gonna be kicked down the road. But it's it's a lot of hassle that they currently certainly don't need.
And then how about you, Xander? Like, don't you already plan that these legacy car companies are going to die faster than you realize?
I mean, I realize it. As Alexandra said, I think those airbags, we've had those recalls, what, like a decade ago? Didn't Tesla have the similar thing? And the other thing I was curious about, how come isn't there like one manufacturer or a couple of manufacturers of airbags and everyone else just shares, or how does that work?
Yeah, there's a couple of suppliers, and there's other subcomponents in here, but I think that the list that could be upwards of 50 million vehicles, and they just they have this big chunk with GM right now, and again it's not only U.S. automakers as well, so we'll have to see how it plays out. I don't believe Tesla's had this problem. They've had other hardware recalls in the past, but nothing of this magnitude, where you're pulling this many vehicles off the road. Again, this is a cost thing. And Alexander's right. There's sub-suppliers involved. There's a lot of people going to be picking up the cost, but that system integration comes back to the OEM, GM, and it will hit them. They can't wound their suppliers to the point where they can't supply anymore. So there'll definitely be some sharing of this, and it could be rather significant. So we'll have to see how it plays out.
Anybody else have any thoughts on this?
No, I think you've covered it pretty well. I would just say real quick, like on X, I don't follow it like Jeff does or Alexandra, but you always see these legacy getting recalled. It's millions and millions of cars. I think on general, Tesla does a really good job. Like once that car leaves, you don't see giant recalls, and like Alexandra said or Jeff, it's a software update, really, really quickly done. You don't have to bring it in and wait and not have your car for a couple of weeks or something like that. So I think Tesla does a great job with that, and Legacy's continuing to do a terrible job and issuing these recalls that cost them billions of dollars. So I think it was well said by Jeff and Alexandra.
All right, let's move to the next topic. Just now, we heard that the SEC has sued Elon Musk in federal court in San Francisco to force him to testify in the probe into his purchase of Twitter in 2022. Let's watch a kind of a report by CNBC when they announced what this was.
SEC is suing Musk because they subpoenaed him in September to show up in court in San Francisco to talk about his Twitter deal, and he didn't show up. And so he was supposed to provide agreed upon testimony, they say, and he didn't show up. And so they have sued him in San Francisco federal court to enforce that subpoena. That's the news.
Okay. I mean, we know Musk doesn't have a particularly good history with the SEC. I think back to the tweet and what happened with regulators there. I mean, any sort of sense or detail around what specifically this could involve with Musk and Twitter?
Well, they just say that the investigation had focused on Musk's purchase of Twitter stock and his disclosures of his Twitter investment. And so they had sought his testimony. They expected him to show up, respond to that subpoena in September. It seems like there was an expectation that he would, and then he didn't. And so now they have sued him in San Francisco federal court to enforce that subpoena.
Okay.
Okay, I'm so confused, guys. Why does the SEC care? And then did Elon just do this in purpose and say, screw you? What's going on?
I forget what.
Screw you. He probably said something else, but I mean, I completely understand why.
What does SEC stand for? I forget what SEC stands for again.
It's Elon in the middle. It's Elon in the middle.
Securities Exchange Commission.
Exactly.
Oh, I thought it was something else for some reason.
No, it is. I mean, I'm sure he thought, I'm not gonna give my precious time to you. And well, now he's got a subpoena because they are trying to play ball and they're trying to prove that they are stronger than him. This is ridiculous. This is drama. As an Elon investor, on a scale from 1 to 10, where we've had really bad days at 10, this is probably a 3.
Yeah, it's a nothing burger, right? But what exactly is the SEC have on Elon? I don't understand. The Twitter deal was pretty...
No. I think if I got it right, and again, I can be corrected on this one, but if I got it right, when he purchased the initial tranche over 5%, but not yet 10%, he had the obligation to publish it at a certain date. Yeah. And they were late for that. I think a day late or 2 days or whatever. It doesn't matter.
More.
But they were late.
It was more. Yeah.
It was more, whatever. But so that's the subject. I mean,
Okay.
Well,
This will
Alexandra,
have a
even more,
penalty.
there might have been a timing, but this is important. I think the form was the wrong form. I
Oh,
think
yeah.
the form that he issued was not actually to the percentage. So I think that was also a big deal. But
Exactly.
go ahead.
So it was not correct and it was late. I think it was both. And so what can happen? I mean, I'm not a lawyer in these things, but he might have a penalty, and so he's going to write a check, and he'll probably don't even see the money, going off his account, and that's going to be it. But the whole noise around it, my God, gonna be something.
Well, I was
We're gonna
saying
hear
it's
it.
actually good. I actually think it's good news because if you read the bio on him, he wants drama. So hey, here's one.
Yeah,
You got
for
something
free.
to. You don't
Well,
have to. You
not
don't have to
for free,
create
but
anything new. You got one.
yeah, I don't think they'll stop him from creating more. But this one is, at the moment there is so much orchestrated hate from the federal agencies against him, his persona. We've talked about it a lot of times. They can't stand him. They can't stand he has X. They can't stand that he is constantly criticizing them. So whenever Elon, I mean, last week it was on illegal immigration. And then you can just see there is one agency and doing something again, right? This is a ping pong game. And as long as Elon is outspoken, he will have to deal with it. And he has enough lawyers. And I think you remember I published that a couple of days ago. They're lawyering up at Tesla more and more and more and more. So just have to defend themselves. And they will. The money have.
Yeah.
Any
I mean,
other
at this
comments?
point, Elon is just the anti-establishment CEO. So if you think about it as like a political campaign, he's pretty much going against the entire system. And that could be good. Elon, I think, likes that back and forth. I think that drives him. When he got in trouble with the SEC the last time for the 420 tweet, after that, and there was some uproar, Tesla came back with a vengeance. So again, this could be kind of good, right? He has someone to battle against when he gets focused, and he's got a lot to prove again. Maybe, he's going to like dig deep and get things, he's doing great, but like it'll give him that added motivation because they're coming after him again. And when Elon gets in that mode, he's going to get in beast mode, and he's going to, focus, and
Destroy
that's
them.
good for shareholders.
Destroy them.
So sometimes people need that. They need the antagonist. They need the enemy to go against, to drive them to get up every morning. And I think Elon kind of is a little bit like that. So we'll see. But it could be a motivator for him. But yeah.
And I actually like it. I like this whole heroic, I'm going against the establishment. I mean, the whole gravy train, how it's working and has been working for tens and tens of years, he's just smashing them. And it comes in soft versions, like we're not doing ads, or we're not playing this game, not that game. And then it comes from time to time hardball. And this is one of the hardball moments.
What do you guys think, though? Right now, I'm really, really happy that he bought X, and it's just a master class of us watching what he did with a company, an organization that was failing, and he, had to come in and just slash and burn, but yet was able to instill a sense of urgency. Coming up with these new business models of how to make sure this company not only kind of survives financially, right, new kind of revenue streams, but also creating kind of the right balance so that you are producing the best quality and so forth. There's lots of mistakes, right? So he pissed off
exactly.
all the
It's still
advertisers.
a mess.
That was like he shot himself in the foot, and he said, "I'm the best at shooting myself in the foot." But they brought back Yacarino, and now the advertisers are back. I think they said 90% of them are back, and so. It's just wonderful to watch this happening in front of our eyes. And then we're playing with X every day, so we can, physically see the new features come out every couple of weeks. There's brand new stuff. And I can see it forming. I can't wait till we see the financial transactions.
Well,
right. And then yes, sure.
Sorry, Herbert, please.
No, that's it. I'm done.
Oh, he's done. Go ahead, Jeff. What do you got?
I was going to say, if you talk to people in Silicon Valley, he came in and basically embarrassed most of Silicon Valley, coming into a company and cutting about 80% of the workforce, and actually turning around features and product faster than the operation that he inherited. And I know there's some warts on, and I know everything's not perfect, and this isn't like a praise Elon kind of comment thing, but it's just a fact. I talked to people, and it really set the tone in the Valley that a lot of these companies, not just on the social media side, but the non-social media side, They have to look in their organizations and say, wow, we may be we may be overstaffed. And from my perspective, I mean, I think it's good, and I think he's onto something. I think a lot of companies took a cue from him. Now, they didn't go as deep as he did. Remember, he's kind of commanding that entire ship, and also he literally bought the entire thing. But I know a lot of CEOs and a lot of senior management had an introspective look after what he did at Twitter. Said, wow, we may be a little bit bloated here. And then you saw a lot of cuts happening. Again, nowhere as much as deep, but it definitely left an impression on Silicon Valley.
Yeah.
So
And just
I
an
wanna ask-
example. Oh, go ahead. Go ahead, Herbert. Go ahead.
Okay. Well, I want to change the topic, so go ahead and finish that one up.
I was going to say real quick, like the power of X for me, and this is not political, but this is just an example. So after the Republicans threw out McCarthy, Gates shows up on a space, and Jeff and Alexandra are on there, and he's literally talking about what just occurred on the vote a few hours later, where the power of the people, right? They're literally asking him questions. He's answering it after one of the most historic things that's ever happened in our country, where we don't have a Speaker of the House. I think in 1910 it happened, but they actually didn't overthrow him. The Speaker held. This time they actually voted him out. So that kind of interaction with your public figures, people that are held accountable to the people, and you're literally an icon, like right next to these people, or possibly could even get onto the speaker board and ask a question. That kind of feedback loop on a platform, that's what Elon's brought, and everybody's not afraid that it's going to be like taken down or shut down because of Elon with the free speech and allowing all the behaviors and different political views to be heard. And I think that's awesome. So I just want to say that I think it's really important, and I think that's great for our country and great for us as individual citizens.
Completely agree. And while I'm the first one to always say it's still a mess and it's still not worth the money if you put more money in it than just the basic subscription, there are a couple of features on X that are now market leading, and I don't see anybody catching up. And by the way, all these other platforms, you don't hear anything about them anymore. I don't even remember most of the names. The one is community notes. It is completely spammed at the moment with actors that spend 24 hours a day in commenting, that especially on the left side of the political spectrum, they are commenting. I don't say this is good or bad, but it shows that there is a need to set the truth right all the time. And there will be more and more people contributing to community notes and make this the main feature. The other one, you're completely right, Christian, is spaces. I mean, that space with Matt Gaetz was something, but there's so many others. I mean, ours on Tuesdays, I love them. I think that they're so interactive, and we're having good guests, and we're having a discussion that is maybe, doesn't need as much preparation as when we do it here recorded. And so there's a fluidity to it and a passion to it that is really special to those spaces. And then obviously the normal discourse, the posts and reposts and whatever. There's so much happening, the ad revenue share and whatever. It's by far not perfect. It's still a mess, but the few things he has already changed, or it's actually a lot of things that he has already changed, is the right thing. And I still think it was the right direction to purchase it, have the user base. Fair enough, there'll be people who will have left, but build on that, even though it's painful. So well done, Elon.
Okay. Yes. So the point that I'm actually most just in awe with Elon and how he runs businesses is this idea that he creates a sense of urgency, and then he gets outsized outcomes and performance from his team and for his business. And that if there is everything looks like it's smooth, he will physically create something so that he could do that, right? And it's just I guess the reason I'm saying that is that as we watched him running Tesla, we're obviously many of us are upset because he will create these drama. But sometimes these drama, not all of them, clearly there's some that he didn't need to do and it was a distraction. But some of them actually just moves the company forward much faster and achieves things that you wouldn't believe could be achieved. So that's what I just want to kind of talk about. What do you guys think about that and his thoughts about that?
Yeah, I think you're right, Herbert. I mean, he's moving so fast, you're going to break some eggs, but when you break some eggs, also some great things are going to happen. So I totally agree with you. I'm actually on I've been kind of tied up a little bit. So I'm on chapter 70 of the book, and wow, if for the audience, if you have not, read the book, or you can get it on audiobook. It's really an amazing read. It's especially the second half of the book. It's fascinating. So if you're a Tesla investor, I think it's must reading. Like, you must listen to the book, because you get an idea of really who Elon is, his flaws, his greatness, his interactions, the way he thinks. It's fascinating. So as an investor, I think it's due diligence to read that book. But I agree with everything you said, Herbert. You're moving so fast, you're going to make a lot of mistakes, but out of a lot of those mistakes, you're going to get some great things, and that's how you really move and advance the value of a company. Yeah.
Yeah, I think that it goes a lot beyond this features and what what X can become. Um, like the NSA having access, or whatever, the government having access to our private communications. Yeah, most of us don't have anything to hide, but it's like, once you start dictating what you can say, and like you saw this with that virus thing. See, I don't even know if I can still say it. Are you going to get demonetized, Herbert? Like that's the crazy part, is that we experienced that. And quick story, I was buying some acoustic foam for the room here, and I met a couple, and the gentleman asked me, it was for his son, but so he's older, he's like in his 70s, and he asked me, how long have I had the Tesla? And we got into a whole conversation, and I gave him an FSD ride, and and I found myself defending Elon with like, oh, the stuff you hear, don't believe the media. And they're like, no, we love Elon. I'm like, oh, do you own any stock? And what it turned out was that he sold electric motors for GE for for like 30 years or something, and he was in that world, and it was interesting to see that regular people that aren't super fans like us, they understand Elon, or in some sort of capacity, and they were blown away with the car, and it was a really good experience. And I just think that something had to be done. I've talked about it in the past on the show. I'm an immigrant, and I came to this country because of what I experienced in the former USSR, and my family brought me here. And to see us, I had a tweet that kind of summed this up, but to see our country going in this direction, where it's more socialist based, and not free markets, and you work hard, you get rewarded. You saw what Elon went through with the taxes, and then you see clips of him saying that if I don't know what you want me to do. You want me to sell tax? You want me to sell shares? I'm supposed to be the guy that gets out last, but I'm put out a poll, and people said go ahead and sell. So he does, but and then a part of me is conspiracy theory thinking that. He just does this because he wanted to sell, and he wanted to have some capital to do stuff like this, because he thinks really, really far ahead. And I think it had to be done, and there has to be a place where people can say things without the fear of, I guess the word is retribution. So I'm not surprised that the SEC is coming after him, and the government, and even though the left is supposed to be pro-climate, it doesn't appear that the guy that's the most climate that you can have to be attacked like this. I think it's foolish, and it shows that like with the UAW stuff, that the president is not supposed to be taking a side. It's very bizarre to see this kind of and I'm just before I get attacked, I'm neither left nor right. I guess I'm somewhere in the middle. I never followed politics. I didn't really like that it's very divisive, so I just look at what's happening and try to offer an opinion. But yeah, that's what I think about it.
I love Xander, and I'm completely with you.
I'm not.
Yeah,
Okay.
Herbert a bit less.
Oh, good. Give me Herbert. Come on. Give it back.
Don't scream. Don't scream. I mean, both of you guys have said things that are kind of insinuating that one side versus the other side. And come on, I can basically defend that if I needed to. But you guys, let that out. Just small little statements here and there. So not worthy for us to dive into right now. Let's change the topic.
No politics here. No politics here.
Yeah, no politics here. You guys have
I
your own
thought
show. You
Xander
can
was
do that.
great. I thought Xander was straight down the middle. He
Sure.
didn't do anything
No.
crazy.
Well, they did. Okay, so let's go here. Here's our topic. Model Y. We already covered the GM recall. We can briefly talk about the different kinds of analysts out there, and then we want to get Alexandra to do a pretty big presentation on ARK Invest. So that's our big topic for the day. So the Model Y, so this was just announced a couple days ago, or maybe longer now, actually. So the Tesla introduced a Model Y rear-wheel drive for just $43,990. This is $3,750 less than the original base model that Model Y was at which they discontinued. So this is a great new segment, right? Because it's just cheaper, and it's obviously it's less miles, less features, but it is a perfect segmentation. I'm very happy that they did this. I think that this is going to just kickstart even more sales of Model Y at the cheaper price. But what you do is you create a new lower segment, and that's exactly what they did. Now that we had a whole show that I've done already talking about why they might have done this because of the batteries and so forth. But still, the idea being that they came out with something like this. What are you guys thinking, and how important is this? Let's go with you, Jeff.
We talked about this early in the year when they were doing the price cuts in January and April, that the playbook in the second half would be more of purposeful introductions of new models where they defeature the COGS, the cost of goods sold, and they do a feature value trade-off and defeature the product and then set it at a new lower MSRP so that they can have neutral, even sometimes better gross margins versus just taking the MSRP side down and then depending on your supply chain to drive COGS. Now they're actually pulling stuff out of the product and saying, here's an entry point now for the Model Y that you never had before as consumers. And then all these consumers that were on the margin that may have afforded a vehicle here can now afford a vehicle a little bit lower potentially and have access to the product. So I think that's the big takeaway is Tesla has now had a series of introductions of product at lower price points where they actually defeature the COGS, take a little bit of pressure off their supply chain. This car is still a subset of other vehicles they build, so they didn't really add a tremendous amount of supply chain complexity at all. Little bit of factory complexity, but I think it's totally manageable given what they're doing here. And we're hearing rumors on X that the order volume on this and just the interest from consumers is really large. So I think this is a great move. By the way, the Model Y entry in China is around $36,000 US. So it just shows you that they're able to bring the cost structure of this configuration down. Both in China, it's the number one selling car there, and then it's and then in the US as well. So I think this is a great move for Tesla. By the way, I think this takes I could be wrong, but I think this takes a lot of the risk of, we're going to cut price to get volume off the table.
Exactly. Yeah, exactly. So tell me if I'm wrong, but it's a game over, right? I mean, here's a US average of all cars right here, the dotted line. And the green is the Model Y and the black is Model 3. And the Model Y and the Model 3 are now lower than a US average. This is the moment we've been waiting for. Price parity with ICE vehicles, cheaper price, and they could even go even further, just like Jeff was saying with the two new models. Thoughts from you guys?
So question to you, Herbert. You always said once they achieve price parity, it's time to advertise. Well, they're under it. Now, don't you want to let the whole world to know how cheap it is?
Exactly. I do now want them to advertise like crazy. And what they will say is it's now cheaper. That's the biggest thing. When you look at the surveys, the number one issue is price. Right. That's the number one issue. And the second is range, those kind of things. And so you got to deal with price.
Well, it's just not price, value. You're getting a great car for the price. Yeah. That's called value. And people love getting value if you're smart.
So
now you just got to let people know. Yeah.
My entry into Tesla was with a standard range Model 3. But for the older crowd, you need the Model Y. So that's exactly what we discussed with this couple today. I told them that this car is now this price, but there's also a $7,500 credit on it. So what you're seeing is before that, and then depending on your state, there's additional incentives, and so it becomes this entry. And the question was, range. Can I charge it at home? Like, these are the types of questions that were asked today, and I think that it's such a smart move. You mentioned something about batteries. I'm not sure that that's why they did it. I think it's their ability to kind of come down market without dropping a price, add a new SKU, and now you can see more people coming. So what happens in January when the credit is at the point of sale? For my mom, we passed down our Subaru when we got the Model X. And as soon as the financing is less on it, we want to offset that interest rate. So if we're able to do it at the point of sale and not have to finance that additional $7,500, Dad and I are talking about splitting the fee for my mom and get her into the safest vehicle possible.
Awesome.
Okay. Wonderful. Let's talk stock and the macro. So tell me what's going on with the stock. It seems to have jumped up in the recent weeks. But then the macro, there's I'm hearing kind of like one day it's like, oh my God, we're off to the races. Another day, Jobs is up again. And then you guys warn me. And then the next day there's some news that says, oh no, we're free. Everything's gonna be great. Obviously, I'm exaggerating a bit, but tell me what's going on, guys.
You want to go, Jeff? I'll go. I'll say something real quick. So, Herbert, as far as the stock goes, I think we're in this wait and hold period. We've been talking about it forever. I think Tesla, it didn't do much today, but I think it's getting some traction with this UAW, right? That every day that this goes longer and longer, and you have the management fighting with the workers and Sean Fain going back and forth, more people are saying, okay, these legacy auto, this is just a nightmare, right? These dealerships, the unions, recalls, and then you got Tesla over here, growing units, looking like a well-oiled machine, doing everything, electrification, that's the future. What do you want to own? Do you want to own the past? Do you want to own the future? So I think just that psychological day after day is just like really hitting investors hard, saying, I got to own some Tesla here. If I'm going to own an auto, I want to own Tesla, even if the valuation is a little bit more. This legacy is going to die. So I think that story's playing through. As far as the macro, we've been talking about it. To me, it's so hard to do. It's very hard to predict. You got so many moving pieces. You have this huge economy. You have deficits and debt, and I'm not going to get all into that, but there is so many liquidity. There's so much things moving. It's very hard because it's all tied together. It's not just as simple as, I'm going to buy a good company and they're going to grow and everything's going to, straight line it, right? We're going to have these major dislocations up and down. And so all I would say is tomorrow's a jobs report. We're recording this on Thursday. It should be out tomorrow. But that'll be big. The ADP report, which is also like a type of job report, was a little weak. I think right now a weak job report is good because what that'll show the Fed is the economy is slowing. Not that we're going to have a recession, but labor's coming down a little bit. Maybe wages is slowing down a little bit. Inflation's coming down, so the Fed could kind of stop raising rates and just kind of pause here and let things be and let the economy play out. And if we can just do that, I think earnings will come through. For most companies, especially the big tech companies, and we'll be okay. I think the market will get nervous if we have another blockbuster jobs report, wage inflation's up, unemployment keeps going, say, down, then it brings the Fed into maybe we have to do a little bit more, which then makes the future look a little bit less attractive because now we got to tighten it even more. And things of that nature, which is not good for the economy. It'll slow things down more. So I just think that's what we're looking for. Tomorrow's job report will be big, and I love what Jeff has to say about
it. What you've seen happen over the last month is you saw the Fed pause in September, but the bond markets basically based on their rhetoric at Powell's rhetoric at the time of pause and his lieutenants afterward, and then some of the economic data that's come out that's been mixed, you basically had this tightening effect that's happened, and where if you think about cars, the 5 and 10-year interest rates and mortgages, the 5 and 10-year interest rates have already added anywhere from 500 basis points, which is 0.5%, to even 0.7%, 700 basis points over that time period. So there's been tightening occurring without them actually having to raise rates. And that puts pressure downward on equities. That's what's happening. Now, the pressure on equities, and this is where it looks like there could be a bid, for the Magnificent Seven stocks, which Tesla is part of, is these are powerful companies with powerful balance sheets, with minimal to zero debt and cash. And Tesla falls into that bucket. So if you've looked at Tesla technically over the last month, it's been trading really strong. That P&D report was considered somewhat weak, and it kind of just traded right through it. And when you see companies kind of sloughing off, bad news that way, and the stock continuing to hold up, I'm a firm believer in analyzing the fundamentals of a company and then overlaying technicals. I don't go technicals first and then tell me what's going on with the company. But fundamentally, we talked about Tesla till we're blue in the face about the upcoming product launches, the strength in the balance sheet, with the fact that we think margins are troughing here, and so fundamentally, it's being set up pretty well, and then now you've got this flight to safety potentially for this Magnificent Seven of like, where are you going to put, if you're going to be in equities at all, well, where are you going to put your money? And it's the companies that are going to get punished are the ones that are heavily in debt, where the financing of their debt is going to be now a lot more expensive, or the companies that rely on the capital markets for liquidity and to shore up their balance sheet, which is what you saw with Rivian today. That was way oversold, that action today on Rivian, but that's what I think it was what's happening with macro and with Tesla. So technically, this 260 level is very important, and if it can hold there, I think there's another technical level that goes up into like the mid 270s, and it's trading very strong from a technical perspective. The volumes are there, so it's really this report tomorrow that Christian referred to. I have a little bit of a, we tend to confuse markets. We had a JOLTS report, which is basically 2-month-old job data that people are concerned like the data is not even real. And then we have a report from a private payroll company called ADP that came out on, I think, Wednesday. And then you have from the Bureau of Labor Statistics, the monthly jobs report, which is going to come out tomorrow. And I think today, jobless claims came out. You have all these reports peppering people and peppering the markets. And quite frankly, they don't have a tremendous amount of credibility. If you actually go look back at the Bureau of Labor and Statistics and the job reports, they're literally being restated by 20-30% on a monthly basis. So if Congress wanted to spend time, looking at things, and these statistics are used to make very important decisions for our economy, you'd think they would spend a little bit more time looking at the origins of this and how this data comes about. But back to Tesla, I think technically it's in good shape. Fundamentally, it's in good shape. It's going to come down to this lead up into earnings. And I'll toss it back to Xander.
Okay, Xander, go ahead.
No, I want Alexandra. She didn't get to go last time. I want her input first, and then I'll go.
Okay, well, mine will be very short because I didn't follow the markets a lot this week. I was quite busy. But one thing I did follow was actually that Rivian note that they're issuing to raise $1.5 billion of capital. I found it very interesting that they are doing a senior convertible note, which means the following. First of all, senior debt means if ever Rivian goes bust, the holders of this bond/convertible bond will be the first one served. The senior tranche is the first one, and then comes the second, third, whatever, and then the last ones get what's left over. So it's a quite secure investment. The second one is they choose a fixed rate, but they also were obliged to have a couple of moments where those that are going to hold that note can switch it to shares. So they had to make it extremely attractive for people to be interested. They wanted to give them at the same time a relatively high interest that is currently on the market, but also all the upside of a potential stock movement. So I found it interesting how much sugar they had to put, or how much, whatever you want to call it, they had to put into this convertible bond to make it attractive and ensure that it's going to be underwritten. So it just shows how tough this market is these days for somebody. I mean, Rivian is a sexy name. If you believe in that company, I mean, if you don't believe it, you're not going to buy it at any condition. But if you believe in that company, these are very favorable conditions. I'm not saying you should buy this, but if somebody is a Rivian fan, this is a good product that they put out there. And the simple fact that they were advised to put so much goodies into the convertible note shows that otherwise they wouldn't have thought they get enough subscribers.
Yeah. Can't hear you, Xander. You're on mute, Xander.
Whoopsies. I hit Control D. I don't know what happened. I think that our panel is just full of so much knowledge. It's ridiculous. Honored that I get to hang out with you guys. But I think that the data, like I'm getting to this point where the data doesn't support another hike, is what it seems like. Yet the Fed is talking very hawkish. And so I wanted to, if you look at the technicals that we were discussing, you have, you have this, the all-time high, and we just came down. You could see we just tried to break through, and we have this low part here where we got to 100, and you have this. If you're going to look at technicals, it looks to me like this is an inverse head and shoulders, and so it came up, it came back down, it's doing this thing, and if you look, it's coiling, and based on what we're seeing with Tesla, it seems like they are poised to break out, right? If nothing has changed in the last year since we had this downturn, in terms of the company has only grown and only gotten better. Like you guys mentioned, they have capital, they are making investments, they're growing units, new products, and AI is like V12. It's just, to me, it seems like if we're going to get this Santa Claus rally, and historically, as mentioned in the last few shows, end of September was very tough, and usually before an election year, you have end of September it's a seasonal thing, and then so a buddy of mine, Frank, who we also met on Clubhouse. Frank, he was pointing out that like last year, this is where Tesla bottomed, or maybe he's at the market, but so we're kind of all in the same boat. We all feel that Tesla's gonna run into the end of the year. Not financial advice. We don't have any clue, but I've gotten very bullish in that I'm buying some calls. I sold some puts out to December, and hoping that that I'm correct. And with the amount that I'm trading, I think I mentioned the last time I started doing the wheel strategy, where I have some money where I'll sell calls against it, or buy puts sell puts against it, and do that fancy options stuff. I'm hoping that at some point, maybe this year, that the Fed says that they're going to pause, but it just seems like they're going to jawbone until because they don't want us to get bullish like this, because obviously the market's gonna react.
My thinking about this is that obviously we're in a quantitative tightening kind of environment, so companies like a high asset purchase like a car is going to be held back. But if I look at the fundamentals of Tesla, like Jeff was saying, it's very, very solid. If you look at it from an automotive company business, right? Very clear. But I think there's two things that could happen that could kickstart the stock, right? And people are just waiting for this. there's one thing could be that if you look at Tesla as a car company, if you look at its competitors, if they continue to falter, like we've talked about at the beginning of this call, this show here, right? Anything that keeps happening, the union fight that they're going through, the continued losses, and even just small things like the recall, everything like that, the new, loss of sales, right? So I know that Gary Black said last week in our space that he goes, if you look at their sales, it's still going right up. Well, those are manufactured financial instruments that was kind of stuffing the channel and so forth. Once that starts to show, and we continue to see how strong and dominant Tesla is, especially now that they're releasing these new segments, lower and lower, a brand new car, those kind of things. Okay, so one thing is when the investors kind of realize, just they're realizing it now, but once they really realize that the game is over, the stock will go up. And the second thing is, it's still seen as an auto company. I still very much believe that the stock is not being given any value at all for all the wonderful things that Tesla is doing. That's not anything to do with auto, right? So AI company and bot company and energy company, and robotaxi, any of those things, when that kind of becomes more solidified with something, whether it's a partnership, whether it's new sales, then that's going to just change the story. It's a story stock, right? So a lot of its beta is because of a story. And right now, people are a little kind of skittish, and still they're still kind of staying off the sidelines, but eventually it's going to pop. And when it pops, it's going to go big. So that's just my own, view of what might happen in the next 6 months.
Yeah, no, I agree with that totally, Herbert. And everyone had great views and great points. I just want to end it on this one little thing. And this is not to be a damper. This is just reality. If you look at the year-to-date gains for the market, it was up, the S&P, I think it got up as high as 17, 18%. It's back down to like 11%, right? We've had a little bit of a drawdown. The Magnificent Seven, which Tesla is part of, is all the gains. It's 7 stocks, is the entire stock market, all the value being attributed to these companies. There are so many good companies that are nowhere. Their stocks are getting crushed again individually. And the only reason the indexes are holding up is because these big companies are such a big weight of the index. So the broader point here is, if you look at the market underneath the market, it's not that great, which could be opportunity, but it shows you that it's still a very weak. The equal weighted S&P, which is the ticker symbol RSP, went negative again for the year. The IWM, which is small cap stock like the Russell 2000, that's negative again. If you look at it on a 5-year basis, it's barely anywhere. It's barely any return. So this is just a lead up into like letting you know that this market is not a very bullish market. If we are entering a new bull market, it really hasn't taken off yet. We're in this kind of a holding period. So there's a lot of opportunities out there, but the Magnificent Seven is literally the market. So that's the broader point I want to get across is there are so many stocks that are nowhere.
And
this is great.
To tie on real quick, so Christian, what's the PE of the S&P 500? Is it like 18, 17 or something like that currently?
Depends what earnings you use. I think if you go with 220, we're like right now, it could be trailing around 19. Like a 19 trailing, something like that.
So my understanding is it's somewhere, it's in the lower part where the market broadly finds that it's worth getting in. We've come down off of those 220 mania valuations of companies. So as you so eloquently put it, only 7 companies are bullish, and everything else is just you still hear a lot of talk of buying puts. You see how Monday and Tuesday were very negative, but then Wednesday you saw there was a face ripper on Tesla, and it's a 5% up, Dave. Why does that occur? So it seems like the market's waiting to go bullish.
It's like Jeff said, though, real quick, it's about the cash, like the Googles of the world, the Amazons, the Apples, the Teslas. These businesses are looked as safe now, safety, almost like Staples almost. So all the money's flowing there. If you're not a profitable company, to Rivian's point, you're getting just destroyed. If you're not making a profit, you are just getting clobbered. No matter how good your things are looking, you are absolutely destroyed, which is opportunity. Like if you believe in a Rivian and you think they're going to make it long term, man, you could buy the valuation has gotten so cheap. But again, they're losing a lot of money per car, kind of where Tesla was. Do you believe RJ Scaringe is the next Elon and could pull this company out and become profitable over the next few years? That's a big bet, because if they can't, it's a zero. So we'll have to see. But yeah, great point.
Okay. All right, let's move on to the next topic, which is ARK Invest. We're going to have Alexandra do a presentation on them, tell us more. But my understanding of ARK Invest is that they're an investment management firm founded in 2014 by Cathie Wood. At the height of 2021, they had up to $50 billion worth of assets, and that fell dramatically last year to $15 billion. But they, uniquely are, one of the few that focuses on disruptive technology, and one of the first to kind of like champion Tesla out there in the market. So go ahead, Alexandra.
Thank you very much, Herbert, and thank you for giving me this opportunity. I've been following ARK now for 2.5 years, nearly 3. And especially, obviously, the down melt that we have seen. And you're right, we'll discuss today ARK in particular, but it actually applies to all of their funds. So ARK was in February 2021, $28 billion. It's now $6 billion. Lost $22 billion on the street. At that moment, the net asset value price for one ETF share of ARK was $152. Now it's $38. It's miserable. It's over a 5-year period, which is the period that Cathie Wood always references to, and which then obviously has the upswing from 2020, where they made a lot of money. The ETF is negative. It's not positive. So it's a complicated situation, and I just want to say ahead of time, it really hurts me because I love it when we have women that are successful in an industry and are outspoken and are right and have a certain aura and have a certain charm they bring to it, and it really changes. And the fund management industry in particular is a very dirty business. I mean, there's some good people in there. I love Ron Barron. I obviously am on the advisory board of Gary, and I want to point out that I play my little role in this industry, but it also comes with a lot of baggage. And so by looking at ARK, when people tell me all the time, the problem from ARK is they have that 10% limit. That 10% limit is actually a crucial problem, but it's much worse than people anticipate. And so I really wanted to talk about that today. So just to start off with, they don't have any 10% limit that the prospectus or the SEC imposes on them. ARK is a fund where they put in the prospectus a 25% limit per sector. So if they would have all EV investments, they don't have any other EV investments in ARK, together, that should not have more than 25%. And in all of the other ARK funds, there is no sector limit at all. They can go to 100% of the sectors because they're actually mostly sector driven. And so the limits that the prospectus and the regulations give them are nearly inexistent, but they self-impose themselves a 10% limit. So 10% limit means that no issuer in their fund should be actively purchased more stock of that issuer once they are at 10%. They can let it run a little bit, and in history it will show that they've let Tesla run up to 15-16% from time to time, especially in ARKQ, less in ARK, but usually they start when they're getting to 13-14%, they start trimming. So the intuition of most people is, oh my gosh, so they don't let their winners run. They always trim them for the sake of diversity. That is true, and I don't like that at all. I've been outspoken about this for over 2 years, that I think this is a stupid role, but it's actually worse than that. Why do I say that? Because intuitively, people would think, okay, so this 10% rule is an issue when the stock rises. Whenever the stock rises, the position in the fund gets bigger, and then they have to sell stock off it. But what actually happened the last 2.5 years is the stock went down, the market went down, the ETF went down. And so we're in the opposite scenario. And yet they also had to trim their Tesla position. And so I want to show you what I think is the reason for that and why I think it's so idiotic. And I'm sorry, I'm not finding nicer words for it. Because again, I have a lot of respect for Cathie and her team on their macro research. I think they're doing a very innovative approach. I don't like their Monte Carlo analysis, but be it. Don't need to like everything. But I found their stock picking skills subpar, and I find their their desire to cling to this 10% rule, highly doubtful. And if my doubts are right that these are done to please institutional investors, actually to the disadvantage of retail investors. And I think that's just not fair. So let's discuss what's happening. Can you please pull up the first graph, which is this one. So this graph shows the fine black line, the stock price since for 5 years. So you see it goes up to, it was actually at the highest, I think, $152, and now it's back down at 38. At the same time, you see in green the institutional ownership of the fund. So this is always by 3 months tranches because they come from the 30 filings from the SEC. So in Q4 of 2022 and Q1 and Q2, the first half year of 2023, nearly 100 million shares outstanding were held by institutional investors. Now, you need to know, and I'll get to that in a second, that the total fund is about 200 million shares. So half the fund for 9 months was held by institutional investors. This is the period, difficult quarter for Tesla, Q4, and then going from $100 back to the $250 range. So the way I interpret this fund, this graph, is actually in 2 ways. First of all, at certain moments, you have to know that your co-investors can be half institutional investors who have not at all the same investment horizon and not at all the same goals than you, the retail investor, that is now suddenly sitting in the same boat. The second point is much more worrying, is that at certain moment, and that actually happened in the last 3 months, these retail investors can just melt down, these institutional investors can just melt down what they're doing. If you can go back to that green chart, please, Herbert, and show it one more time, you see that in the last quarter, it suddenly fell from 100 million shares back to 70 million shares. So 30 million shares were thrown back into the market by these institutional investors. So what does this mean technically? An ETF is actually like a moving thing, meaning when, let's say, an institutional investor, it would have been one single one, and he would have thrown these 30 million shares on one single day back at ARK. That doesn't mean ARK purchases this 30 million, but it means that ARK will, on that particular day, sell all their stocks proportionally to what they had to come up with the 30 million stock value. So if the stock value was $30, it would have been $100 million. So whatever they will have to do is immediately replicated in the fund. Okay, so what does that mean? First of all, it means that the ARK's management fees depend in certain quarters on a handful of institutional investors. That's their source of income. The second thing is that whenever institutionals leave, they will be much more active at finding retail investors. So when you see these statistics and when you see Cathie Wood on TV and whatever, you have to check whether there is no correlation. I haven't, pointed it down to the day, but they are constantly in the need of replacing the institutional investors when they come in, or vice versa. Now, if we can go to the next chart, please. Okay, so these are the number of outstanding shares. Remember, just earlier I told you 100 million of these shares were by institutional investors. As you can see, this is the total number, and it's actually quite steady around 200 million. It went down a little bit beginning of 2022 to 170 million. It went up to 210 million. But the number of outstanding shares over the last 2.5 years hardly moved. So it's not as if people are leaving the fund in droves. And it also means that there is obviously a cushion between what the institutional investors do and what the retail investors do. There is some movement in there, which is difficult to explain. But the one lesson the one thing I want you to remember is the number of shares actually hardly moved. Okay, so it's not as if the number of shares melted down, but what did melt down Yeah, you can share the next one, Herbert, if you don't mind. This is over the 3 funds, but what's really important is the next one. So this is the same number. The blue line is what we just saw here in the blue bars. But if you want to bring up the next one, Herbert, is while the number of shares of the ETF hardly moved, the number of Tesla shares in the ETFs melted down completely. So why is that? So I looked at that for a long time, and I'm following it on a daily basis. And sometimes you have to zoom out to ask yourself these questions. So please all understand this is obviously split adjusted. At the height, when ARK was 28 billion and the other funds, and it all summed up to largely in the 30 billions, they held 16 million Tesla shares. The shares of the ETFs remain stable. So they should still hold 16 million shares. It's not because the prices went down that is a reason to sell. Not at all. As long as the ETF shares remain stable, there is no reason to sell other than, and that's the next graph, that the rest of your portfolio, meaning the 90% shares that you don't have in Tesla, actually underperform. So that is what happened. You see here in the blue line, ARK. So it lost 75% of its value. That's what it says here. It's a bit blurry. But that is how ARK performed in the last 2.5 years. And you have below here the 2 other big positions, which is Roku and Zoom. And Roku and Zoom are at minus 85%, but they are, as you can see, quite parallel to ARK. But you see in red above Tesla, and Tesla is about flat when you compare it to February 2021. So what happened is the underperformance of the rest of the portfolio obliged ARK to constantly trim Tesla. Why? Because the others underperformed, Tesla overperformed, and hence had more than 10% of the portfolio. So the performance, the allocation of Tesla in the fund didn't really move because of Tesla's stock price, but was hindered or was blocked or was obliged to trim because the others underperformed so much. And the result of this all was that the fund who had at one moment 16 million shares has today less than 4 million shares. And so what I'm trying to say is investing into ARK today, the investor has the potential of 4 million shares. While 2.5 years ago, he purchased in his share purchase, in his ETF purchase, the potential of 16 million shares. So ARK's trimming is not only an issue when the stock goes up, and hence the 10% limit is reached, but also when the stock goes down, if the other stocks go down even more. And therefore, for me, it's such a disappointment. It's such a disappointment because a firm like hers, who is so outspoken on the price target of Tesla, 2027, $2,000, a firm like hers who is so disruptive, thank you, yeah, that is it, was not able to tell its investors, look, forget about a 10% limit. That is what Ron Barron did. When Ron Barron had Tesla in his fund and got to the 10%, they wrote to their investors. They said, please vote what you want to do. And they said, we want to keep on going. And now they are at 40%, right? And now the 40% of Ron Barron's fund is Tesla. But why can ARK not do that? Well, they can't do it because then they won't have the institutional investors in there. That was my first green graph. If you want to make sure that these institutional investors come in, stay for a couple of months, generate management fees, which are horrendously high, that is the price you pay. And as a retail investor, that is the company you're in the boat with. Voilà.
Wow.
Very nice, thorough, Alexandra. That's good.
Wow. But it's more than just that. It's fascinating. Like to tie it all together, I'm blown away here. So
Thank you, Xander.
I think we know the expense ratio of ETFs, and like ARK's research is why I'm here. I'm a huge fan of it. I actually my original Twitter thing was this golden goose, which is the $22,000 by 2025 or something like that scenario, pre-split. So that'd be 22 divided by 15. And I absolutely love the declining cost curves and the research that they put out with Moore's law and Wright's law, and that's the stuff that's bullish. I fell in love with Tesla because of it. Once you look under the hood, but that's exactly why I do not listen to anyone else when it comes to a decision, or trust anyone else except Elon with my retirement money. Yeah, I don't want to own Roku. I don't want to own anything else, and I know it's dangerous, and I understand. Being 100% in one company is super dangerous, but at the same time, outperformance-wise, I think I have a better chance than following that. And again, I love Cathie Wood and Tasha Keeney. I think their research is brilliant, and the other guys, what's his name, Sam, I think. Anyway, but I thought that your point about that they need the fees to operate and that institutions dictate what ARK has to do that's a deal breaker for me.
Mm-hmm. Yeah,
can I kind of ask something?
Go ahead, Herbert.
Yeah, I want to ask something just to understand this better, right? Just to give the other side perspective, possibly. I may be completely wrong. Okay, so you revealed quite a number of things that I did not know about, because we all thought it was because of the 10% rule that's why they were buying and selling. But clearly what they were doing was selling when it was high, but they're also selling when it's low. And why do they do that? And scratching your head. Okay. But step back and think about this, right? So this is an investment management firm that has chosen to focus on disruptive innovation companies. And so they do pick things like Roku that obviously fell. But this was during an environment, right, with quantitative tightening, when the economy is struggling. So anything that's disruptive innovation is going to get hit really hard. And so
we understand that. And I completely understand that.
Yeah. Which graph is it that I want to show? That one? No, I can't. I think that one there. But anyways, where the stock went up, the stock went down, of course, because what hit it? The recession hit it and all that. So the point being that if you're going to play with this risky, high beta kind of stocks, you're going to get hit during a recession. But when it turns around, Tesla's going to go skyrocket again and so forth. So they kind of need to play their thing. Can you just explain that side of it?
I will. Well, my point is, I completely understand if you take a certain risk, you have a certain market, and in that market, you will follow what the market does. That's not my problem, right? If you go into a market that is small cap or even less, well, you will have this high volatility and you will be hurt in the current environment. I completely understand that. My point today is that 10% rule actually harms their best bet, a bet on which they do all the research, because of the other funds in a overproportional manner. That this good horse, the family silver in the threshold, is used to cover up the rest. Why? Because the rest is the rest is more volatile. So let's assume there are only 2 stocks in an ETF. Obviously, there are about 30 or 40 of them. But let's just, for the sake of it, for explaining it, say there are only 2 stocks: Tesla and a lame duck. They both start at 50%, and let's say it's a 50% rule, but it doesn't matter. If the lame duck goes down a lot, well, let's say that the lame duck goes from 50 to 30, so Tesla would go from 50 to 70, but it has to stay with the 50% rule. It will always shave off, even though you're in a down market. So you're selling in a down market. My big grievance today is that we're having as many ETF shares. There's still as many people holding the ETF, whether it be institutional or retail, but the fund itself melted down from holding 16 million Tesla shares to 4 million. And these 12 million lost shares, they're not coming back, because even if the stock now, if all the stocks move up, they will still trim Tesla all the time. So they trimmed Tesla going down because they sold the family silver, because they had to, because the other stocks were even, performing much less. And so they had to get the money from somewhere. And at the same time, now when it goes up, they will trim again. They're trimming when your strongest stock is winning, but they're also trimming when your strongest stock is losing less than the other losers. So for me, it is about the quantity of stock in the portfolio. And while the first part people intuitively understand, the second part is something where you just, you can't believe that they would do that, but they do. And it actually hit me last night. Why did it hit me so much? Yesterday, the stock did nearly 6%. They sold, but the allocations in the fund went up. And I said, here we are again. Because the rest of the market yesterday didn't do 6%, but Tesla did 6%. Well, they trimmed and threw out these shares out of the window, sold, because the rest didn't catch up. So the proportion of Tesla blew up again, and off it went. And so they're constantly reducing the number of shares. Now, from time to time, and she did that right actually end of December, beginning of January, from time to time, they just increase their position because they have suddenly a big conviction on Tesla. So that's wonderful. But then they have an over proportion, and then it melts down again. So it strikes me as, this 10% rule is, for me, their concession to institutional investors. They can know that because if an institutional investor wants Tesla, they're probably going to run barren or goes to the market himself. But they go, we're a disruptive fund. We're not holding cash. We're only in crazy tiny caps and Tesla, but we're not going over 10% with Tesla. So that brings them that institutional money. But the globality, and especially the long-term retail investor, pays dearly for it, but because he's losing all this upside potential of the number of Tesla stocks in the portfolio. That's exactly what I want to say.
Yeah.
Well said. Herbert, could I have my piece on this? This is big for me, and I'm going to be very respectful. So from a general, that was a great presentation, Alexandra. Xander, great points. Herbert, great points. Now, I'm just going to be very general. Cathie Wood is known for Tesla. So 5 years ago, if you wanted to buy Tesla and you thought you were being safe by going with Cathie Wood's fund, you are down. You're negative 5 years when Tesla's done more than a 10x, roughly like that. I put the stats out on X all the time. I do her charts. She's like a negative 12% over a 5-year period. If you just own Tesla stock outright, you made a killing. You're over 1,000% return when you're a negative return in her fund. So if you're a retail investor and you're thinking, I'm going to own Cathie Wood because she has Tesla, that did you no good. So to your point, all the great research she does that Xander spoke of, all the great macro analysis she does, what good is it if you have no performance? Her job as a fund manager is to give you a return. So if she's giving great interviews and she's giving great macro analysis, but she's not doing anything in her fund, not raising cash, maybe buying companies that would perform better in a certain macro. If you're not doing any adjustments, you're just saying this is my strategy, and you're known for Tesla, and Tesla's doing more than a 10x, and you're negative in the same period. To me, I mean, that is just unconscionable. So that's my first point. My second point is ETFs are a great thing. They're very efficient. And most ETFs, if you just buy the SPY, which is the S&P 500, or the triple Qs, which is the NASDAQ 100, which has a lot of the Magnificent Seven, it's market weighted. You're fine, and you're paying like 8 basis points. I don't know exactly. It's under 10 basis points. Where Cathie's fund is 1%. So whatever you put in there, she's going to collect 1% off of that. Anything. So again,
0.75 because they adjusted it. 0.75.
Okay. Well, okay. I know it was 1% at one time, but what I'm saying is you could buy literally the market. And you would have, the Qs are up 100%, I think roughly 90-something% over 5 years. You're negative 12 in Cathie. And you paid her to be negative 12. You paid a bigger fee than just buying the ETF, the QQQ, or the SPY.
Yeah, they're one of the most profitable. They're one of the most profitable ETF firms, no doubt about it.
That's point 2. And then point 3 is, where was I at? So there's 2 big points. Oh, the Magnificent Seven. She hates, I don't think she even owns Google. She sold NVIDIA before it had its run. What's more innovative than NVIDIA with AI and these chips? Google, one of the biggest companies in the world with AI. They've been doing AI for 20 years.
Explain me Roku. The day somebody
Yeah,
explains me
Roku,
Roku and Teladoc, I'm
COVID.
gone.
It was because
Square.
of that.
Yeah, but those are not that really innovative companies. Now, you could debate it, but again, I'm going to my bigger point is all this stuff, if it doesn't produce any results, it's not really great for the retail investor. And again, so I think that's a point because I talk about it. A lot of people that reply back to me didn't realize that ARK had such a bad return and didn't realize some of these things. So I think Alexandra just did a great service there. I'm doing my little bit here to try to get people aware of fees, what you're buying, how it affects it, rather than just saying, oh, she's on TV, she must know what she's doing. Because over the last 5 years, you've really, been crushed if you're in those funds rather than just buying outright or just buying the market, the SPY or the Q. So I just want to get that point across. And I think it's important. So I think we've done a great job on the show to let the retail investor, who probably 99% is watching our show, understand that. So I said my piece there. I think she's a smart woman. I think she's a great businesswoman, but her fund has done terrible. It's just fact. Go look it up. Now, maybe it recovers in the future, but as of now, it's been a big disappointment. So I'll shut up there. Go ahead, Jeff. Love to hear what you have to say about it.
I'll be quick. I come from tech, and when I look, it's almost like there's two different companies here. There's the one that, I love hearing, the research that they do. Sam, Tasha, multiple folks inside of ARK. I read it, I understand it, and it's almost like it's a different company again because I come from tech. I would have never invested in some of these companies. I don't see any kind of competitive moat with Zoom or with Teladoc or with Roku. I don't. It's almost like that's a different company inside of ARK that's making decisions. Now it's easy for us to sit back and maybe there's something we're missing here, but it just seems like the breadth of research, the early calls on Tesla, even the early calls. Remember, they did some early calls on Amazon too, that they should be credited for. And it just seems like there's different. It's almost like there's different, like there's inconsistencies happening within that group, and it's like the group that did the Tesla research and was kind of the golden goose for that company is now taking a hit based on the underperformance of everything else. So I'm glad Alexander was able to go through that. I think most people do not understand what actually is happening until Alexander was able to go through that. So I really appreciate that.
Okay. And last point, Herbert, before we move on, Alexander, did I understand this so correctly? It's because the underlying stocks dropped, the Tesla proportion in that fund grows too big, and they decide to trim it. Okay, so I got that correct. I thought that the Magnificent Seven, by that point, the prior point that you guys were making, was that they're not able to participate in it because they keep trailing off. So okay, I understood that correctly, and hopefully some audience members are getting some clarification. I wonder what Gary Black would say. Would he defend it, or would he just say, hey, you need to diversify? You can't, as a fund manager, you can't just
sure.
you
That's
can't
what they
just
say.
yeah.
You have to diversify. And whenever I bring up Ron Barron, and this is not only Gary, this is also Ross or whoever else I speak to in that universe, they don't like what Ron Barron is doing. And you have to know Ron Barron is actually a mutual fund. So a mutual fund has to publish only once every quarter, at the end of the quarter, their portfolio. And it's not an ETF. So it's not the same scrutiny. I can't include it in my tables because I could talk about it only once per trimester, per quarter. But it gives them a nice way out. Oh, we don't compare to Ron Barron. BS, right? They should. I mean, if you're a Tesla investor and if you considered ARK, and probably if you're down under now, you may not want to leave now. I can understand that. But switching to a Ron Barron fund or managing your money yourself is probably an option you should think about. Just because I hate this institutional part in there, because the mutual fund, that's the other thing. Even if they would have, I've never studied those funds, but even if they would have institutionals in there, since it's a mutual fund, it is, they can't just go in and out every day. It's not the same mechanism, right? The ETF, I always wonder, and just a quick story. So in my long career, I was at one moment in charge of the German equivalent to REITs, and people could trade real estate funds on a daily basis. And it was just the thing that's not possible. You cannot have daily liquidity for a real estate portfolio. And in the end, a market of 80 billion euros that I was in charge of rating collapsed because my big mouth just said it, what nobody ever wanted to say. It's a long story, and I don't want to really get into it. Brought a lot of heat to me, my name, and whatever. You can still find it on the internet. But I was able to express exactly the issue of those funds, and that issue was real, and somebody had to unveil it. The issue with ARK is an ETF can live, but an ETF where you try to have a large portion of institutionals, because they pay the same 0.75% daily management fees, and retail investors, and make promises, yet trim your biggest winner all the time, or your best underperformer all the time, leads to a fund that does not have the same substance anymore and doesn't give you the promise that was initially made.
And real quick, Herbert, I know you want to talk, but I have one more thing. Alexandra, am I right on this? The theory is Tesla's doing well. Let me trim that because maybe that upside is capped. And let me go buy the things that I have that are getting destroyed because they're really going to recover. But they never do.
Exactly.
They keep going lower and lower and lower.
And then add to it that the little ones have much smaller market caps, right? A much higher risk. So you have your one large cap, which is Tesla, which certainly is volatile. I'm not saying Tesla is not volatile, but I mean, the volatility on Tesla has nothing to do with the Zoom, then a Roku, a Teladoc, and whatever else names they're in there. So you are trimming your Tesla, and you're going to invest it in those small caps where actually, fair enough, in your fund, it may only be 5%, but of their outstanding shares, you may be at 15% now because you're now suddenly the biggest investors in those small caps because the money that you're bringing in there is a lot of money compared to the market size of these funds. So there is a lot of mechanism in there that does make no sense whatsoever. And it's all based on that 10% promise. And if I could ask one question to Cathie Wood, it would be, to whom do you promise these 10%? Because I really would like to know.
Okay. Well, first of all, I'm not invested in ARK Invest. I just want to make sure that we don't position this whole talk so far on one side of it. I've interviewed Tasha Keeney, and just like you guys had mentioned earlier, their research is top notch, and I believe that the things that they are predicting are going to come true. I respect them so much for coming out early, doing deep research with so much conviction, and of course, the vast majority of researchers and investor analysts, they're blind to this. They don't believe it, and then it'll come true. So I believe that what they're thinking about is correct. Now, you've unearthed some issues with their kind of the structure of how they've organized their fund. But I think that I just go back to, do you want to invest in kind of a philosophy, right? The thesis of this fund is that it's going to do disruptive innovation, and there's going to be tremendous swings. That's just what it is. So I know that Christian brought up that they're down if you look at 5 or even maybe 6 years, right? 2014 now. So it's just, they're down, but it's again
10 years. Yeah,
when they go up, this is down. Of course, Tesla is one of the big holdings, and of course Tesla fell, right? We all are down. Okay. Those of us who are so heavily in Tesla, we're down comparatively, but it's going to be outsized 10x growth.
Well, can I put that in perspective? Since the day ARK was incepted, which was the 31st of October, so nearly exactly 9 years ago, 2014, 31st of October, Tesla since that day did a 15x, 1,521%. They did 91%. Okay, so yes, it will go up, but it will not go up like a single stock. And that's not the promise. No fund
Understood.
promises that it will go up, but it's not as if this fund is a rocket. It's not. It is
No,
not.
so
Everything has to go right for every 35 stocks. But on top of it, whenever one of them, and it could be something else in Tesla, who knows? Maybe one of the other stocks has a run. But whenever they get to the 10%, they bring them down, which we all know about, which is stupid. But the thing that I'm even more concerned is even when it goes down, they trim the winners.
Okay, so let's There are people like me and you who are all in on one stock, which is crazy for many people to even consider that that's the case. Okay, but we are people like that. Then there are people who are very, very much on the far left, which is I'm just going to do it on the S&P ETF and let it go there, and so safe. Okay, much safer. And of course, there's the bond people and the cash people, right? Now, these guys
No, that's
are.
Buffett. Buffett says that's the best strategy too. He would do it. Yeah.
Okay. Then there are people like a Ron Barron, who is again very much like us, very heavily in one stock. These guys are picking a lane that might have been a mistake, which is heavy on one stock, but then also an ETF with multiple others, very tiny little disruptive innovation. Now, the promise was that if one of them really did hit this, again, a disruptive innovation is you're planning and thinking that the world is going to change in your favor. And if it does, and you have a multiple of them, so one of them hits, it becomes equal to or 50% of what Tesla could become. Then they get into that game, and that's what they're doing. So if you know what I mean, like it's like this in between world, and so it's hammering them right now.
In between world, ARK wins in management fees, and that 10% rule. I'm sorry to say so, but the 10% rule harms the long-term investor, and that's just and that 10% rule is not in the prospectus, is not imposed by the SEC, is not. So while they're doing a marvelous job in their research, you may or not agree with the methodology, but I do believe it's really worth your time understanding their research and reading their research. I think that what's happening on the fund management side is subpar, and they never address it. And just I agree with you, Herbert. Go ahead. I agree with you. They're a great company. I mean, there's no doubt about it.
One other question for you is like, okay, so if you're invested in ARK Invest, you should be kind of looking at this and listening to this. But if you're not invested in ARK Invest, what does it matter to me, the Tesla investor, outside of all this?
Nothing.
Not much. Because when they sell, it's tiny amounts. It's big amounts.
It gets tinier and tinier. Exactly.
It's not going to move the market as much anyways.
Completely agree. When I started looking at them, they had 13 million stock. So when they did something, it moved the market, right? Now, with not even 4 million stock left, I do my daily tables, but I can tell you once a week, I tell myself, is it really still worth my time? I mean, I do it because I find it interesting. I see the option strategies of VCAR. I look what Gary's doing. I look how bad Ross's fund this year, 7.5%. Ross is the underperformer of the whole market. It's crazy how bad his fund is. So it's interesting because I just, I like that universe, but it is true that ARK is not moving the market anymore. It is not.
Yeah.
We're making lots of friends today. We're making lots of friends.
Yeah. So Buffett can own 50% of Apple, but Cathie can't.
Let me clarify. So Buffett does that. But if you ask Buffett, when he dies, what would he want? He says, put it in the S&P 500. That's what I would want for his family.
Yes.
So what I was trying to say is, Buffett says buy the market because it's increasingly different to beat the market. So Buffett says, I'll go against any fund manager, any ETF. I'll buy the S&P 10 years. He did a bet and he won. He crushed active managers. The S&P 500, everyone says it's boring, it's stupid. It crushes 90% of active managers, Xander. That's what you have to understand. Just owning the market.
I come from the 40% total stock, 40% total international, 20% bonds. And then I discovered that bonds was just for you not to panic when the market tanks. And so I got rid of that and was 50 and 50 because we have a home country bias here. So I was taught the Vanguard, the Bogleheads
Jack Bogle
way.
Jack Bogle.
Yeah, exactly. So I was trained that way. And so to go to this extreme, maybe it says something. Maybe it says I'm insane and a high risk taker, which I agree I am, especially with the options. But the point is that where do you want? You want to ride the horse that keeps winning the what do they call it?
I can tell you what the best ETF is. The best ETF is Tesla. It is diversified. It is diversified. You have cars, you have energy, you
don't
have
say
AI,
I'm listening. I'm
you
sorry.
have services, you have everything in there. There's no management fee. We even have a crazy CEO. We have everything. Drama, love, everything's there.
And yet
I
the
love it.
company
You know,
will
I love
succeed big time.
Alexandra. I respect that. I disagree a little bit, but I respect it.
There you go.
It is so true, though. Okay.
It
Because
is,
we
right,
spend
Herbert? I mean, on this
It
one,
is.
that nobody can convince me of anything else.
There's never been a company like this. There's never
Exactly.
been. Apple
I agree
and
with that.
Google are
Exactly.
one-trick ponies, if you think about it.
Yeah.
And by the way,
Yeah.
I was going to tell you this. This is interesting. You know, I know we're out of time here, but this reminded
great
me
show.
very much of Apple. Because think about this. Okay, the brand loyalty within Tesla is so strong that when they were surveyed, the Tesla owners, 37% would buy a Cybertruck versus any of the other cars, right? That's a very much a similar situation that Apple has. That they have their own market. They have like 18% of the market. That's not 100%, but it's enough, and they don't care because they can just keep selling to that same market over and over and over again, services beyond products, and they will just, margin machine. They're a margin machine. So we're going to get there. This company will get there as they expand their services to everything in the world.
Absolutely. It's a great company. And
it's
before we end,
amazing.
Herbert, if you don't forget, that was today's show. I learned a lot. It was fascinating give and take. Everyone here, go follow Herbert, Alexandra, Jeff, Xander. They are on top of it. They are nailing it. And this was a great show, informative, fun. So I hope you guys enjoyed out there. Herbert puts a lot of time into it. Alexandra, Jeff is amazing. Xander. So go follow these people. They're really good. And guess what? They're honest, and we try to do our best. We try to tell the truth. We're not always going to be right, perfect, but we try to do it, and we try to, state what we believe is the fact. So great cast.
Nicely said.
Thank you,
the last thing
Christian.
you should have just said was Herbert's always right. Not going to get you to say that.
And
What about our
follow the
Tuesday
follow the
space?
CyberBulls
Yes.
X account, and listen to us on Spaces on Tuesday afternoons.
Yeah.
Wonderful. Thank you
It's
so
fun.
much, guys. That was wonderful. You guys did the ending for me. So yes, CyberBulls does a space now every Tuesdays at 3 p.m. Pacific. And then we're also doing this show every Friday. So thank you guys very much. Appreciate everybody. See you soon. If you can, please consider supporting this channel. It's a lot of work arranging all of these amazing interviews. I've created a website that is the most comprehensive resource for the Tesla investor. It has over 15 modules to keep you informed. Please check it out. Simply go to my website at herbertong.com. Thank you very much, and let's get brighter.